Welcome back. We are now in chapter 11, and in this chapter we'll be taking an example of a real life company and try to assess the financial portion of this company. Now going forward, what we'll actually do is we'll take 4 case studies, 2 relating to working capital and 2 relating to term loan. Okay, so in term loan, what we'll see is if you're getting a fresh proposal, right? If a proposal comes for a fresh term loan, that is, this is a new project. Okay, so what are the things that you need to look into when you get a such proposal, right? That is one case study which we'll be discussing. Then we'll take another case study that's also related to term loan, but this is say 1 or 2 years after, right, after the sanction was done, right? So in this sort of proposals, you will not have a request for term loan. Term loan was also already sanctioned, say last year, and now the company has come for renewal of working capital or enhancement. So there is no request for term loan. But then in these sort of proposals, what you need to look at, because last year, right, you have sanctioned a term loan, and now you need to see whether the progress of the whether the term loan was fully dispersed and whether the proportionate margin was brought in. What is the progress of the project? Okay, so these sort of things, whether DCCO was achieved. Okay, there are many things which you need to consider. What are the aspects that you need to consider in such proposals? We'll be discussing in this case study. Okay, that we'll take a separate case study. Okay, so two case studies related to term loans. Then what we'll do a case study on working capital assessment. Okay, say a company has come for renewal or enhancement of working capital limit. What are the factors to consider? That will be another case study. And last case study also related to working capital. This will be under cash budget, because cash budget you need to look into separate aspects compared to a regular manufacturing unit. Okay, because in cash budget you have to drop a monthly cash budget. So going forward in the next 4 chapters, what we'll do is we'll take these 4 case studies. Okay, 2 relating to term loan and 2 relating to working capital. But what we'll do in this present chapter, right, we'll take an example of a company and we'll try to assess just the financial position. Okay, we'll just try to assess the financial position. Okay, nothing more than that. We're not going to take the CMA data. Will not take the same data. We are not concerned about the projections. Projections will be taken up in the subsequent in these sort of the other 4 case studies, because they will be coming for sanction of fresh term loan or enhancement of working capital. These are projections. There you need CMA data. In this example, in the present chapter, will not focus on CMA data. We'll just see, given a company's balance sheet, right? Given a company's balance sheet, say for example for 2013 or for the last 2 years or 3 years, right? So what are the aspects that you need to look into, just to assess the financial position of a company, so that we'll get comfortable with what are the points that you need to look into while assessing financial position of a company, and then we will take it forward in the next chapters, right? The example we'll consider in this case study. This is the data. This is the P&L account, and this is the balance sheet for the company. The font might be on a bit on the lower side, but since you also have access to that to the PDF file, you can go through the relevant section and just see the figures in case this is not visible, or you can try to zoom it up, right? So basically we have here a 5 years data. This is the P&L account, right? This is the in the CMA format. Okay, maybe some blank rows were deleted even in the liabilities and assets. It's not exactly as per the CMA format, but any blank rows were deleted so as to fit it into one screen. But basically this is the data. Okay, so we have a company, we have 5 years past data starting from 2008. Okay, starting from 2008, 9, 10, 11 and 12. 5 years data we have. Some banks while assessing financial position just consider 3 years data, right? Some banks do consider 5 years data, right? I think banks like Canara Bank do this 5 years, but again it depends on the bank policy. But anyway, right, we'll take here 5 years data and try to see what is the financial position of this particular company. Take a moment or two to just go through the these 3 statements. Okay, the P&L account and the liabilities and the assets. Okay, so just take a couple of minutes to go through these figures and just try to spot and try to spot anything of interest from a financial point, right? So hope you have gone through this financial. So when you're given a balance sheet, where to start? Now this is a very important question, where to start, because the numbers are overwhelming, right? There are a lot of items in the P&L account. You have a lot of expense items, right? Even in balance sheet, a lot of liabilities and assets. So where do you exactly start to get a overall feel of the company? So top line and bottom line are 2 figures which are normally focused on in analysis. Okay, so what is the top line and bottom line? We're referring to the P&L account. So if in the P&L account, if you remember the CMA data, we start with sales and then go on to relate to all expenses, and finally arrive at what is known as profit after tax. So top line is the first line, right? That is the turnover. Okay, so when we say top line, we are referring actually to the turnover, and the bottom line is the last line. All expenses deducted, finally we arrive at what is known as a profit. Okay, so that's the bottom line. So whenever you come across these terms called top line and bottom line, basically we are referring to the turnover and the profit. So this is a good place to start your analysis. So whenever you're given a P&L account or balance sheet, it's a very good point. This is a very good place to start because it gives you a rough idea. It gives you an immediate idea as to the performance of this company. Again, you need to dig deeper into or calculate lot of ratios to get at the exact position. But then to get a preliminary idea as to how this company is doing, let us start with the top line and the bottom line. Okay, and what are the things that you need to look at the top line? In particular, what you need to look into is the trend. You know, it's not about turnover of this year. You know, when you have the balance sheet of 2012, for example, it's not enough if you just look at the turnover of this year, right? You have to see it in comparison with the trend, the past say 2 to say 3 years or 5 years. So this will give you the trend of sales, whether this company is actually increasing its sales or decreasing, right? So that is a preliminary thing that you need to do in any proposal. Okay, yes, you need to compare it with the CMA data project given at the last time renewal. Okay, so whether the company has achieved the projection it is given or not, that is one thing that will come into later. But even without considering the CMA data and the projections, just look at the past 2 to 3 years turnover and just try to get an idea whether the sales are increasing or not. Okay, so that's the first thing. The second thing that you need to look at is the rate at which the sales is growing. It's not enough just if it is growing. You know, say for example you have a last year sales of say 100 lakhs. It's now it's 105. This is a very flat growth. I mean, this is not even a growth. You know, it's not enough if the absolute figures increase. Now this is even if the turnover is increasing, it's by and large at the same level. Now what you are looking at is the growth rate. Okay, a healthy growth rate. Say for example 10 to 15% is a normal growth rate in any business, right? If everything goes on well, even if the company doesn't adopt a very aggressive policy of marketing, you know, 10% to 15% increase is a normal growth rate many companies experience. So look at the growth rate, right? Look at first look at the trend, whether it's increasing or decreasing. Next look at the growth rate, okay, in percentage terms. Calculate the growth rate in the last say 2 to 3 years, right? Say for example in 2011, that is compared to 2010, maybe the company has grown at say 10%. Maybe last year in 2011-12, the financial year, the company has grown say for example 12%. Now in the current year 12-13, the company has say for example increased by 15%. This is a healthy growth rate, right? The sales are increasing, and moreover the rate at which the growth is happening is a healthy growth rate. So that is one thing you look at. The one more important thing is this growth rate above or below the industry average? You have to always look at performance of a company in relation to two things. One, with respect to its own performance in the past 2 to 3 years. Okay, say any item, say for example raw material. Look at the raw material consumption of this company for the past 2 to 3 years. So this will say for example for every 1 ton of output, say the company is consuming say 1.2 tons output 3 years back. Right now it is consuming say for example 1.5 tons, produce that same output of 1 ton. So you can see that over the past 2 to 3 years the company, something is happening at the operational level, right? Maybe the production efficiency has come down, maybe there's some lacuna in the process. Okay, so this is comparison within the same company. You also need to look at the parameters with respect to the overall industry. Say for example the company is experiencing a downturn in sales, right? For the last 3 years, say for example the company is increasing, say this is a 250 lakhs, then it has come to 240, maybe 210, maybe you can see that the sales of the company is decreasing. But if the industry as a whole is also not doing well, maybe this is an export oriented unit, right? Say for example the exchange rate is not favorable, or the country, the major export destination to which this industry is exporting is having a downturn in its economy. So there are various factors, right? So if the industry as a whole is not doing well, then really you cannot blame the company, right? So you have to segregate internal factors and external factors. So if there is a decline in sales or on any other parameter the company is not doing well, is it because the company itself is not doing well, or the industry as a whole is being affected, right? That is one more thing you have to do, and that's why whenever you look at the sales or profitability, you have to always compare it with the industry average. Where will you get this industry average? Right, if you are a banker, right, industry average is something you can compare it with similar accounts in your portfolio, right, of similar size. Say for example you are dealing with, say for example, a fertilizer fertilizers manufacturing unit. So if possible, try to get similar fertilizer units located in the same region to which your bank has extended finance. So that will be a good starting point, provided the size of these units are roughly the same. In case it is not possible, you can compare it with neighboring zones, right, where you have some contacts within your own bank. You can do that. There will be always available some industry journals, CRISIL reports. There are various ways in which you can access this inter-company comparisons, right? The industry scenario is always something you have to keep a watch on. Okay, you should have a list of common industries, right, and the performance, right, and what is the outlook for the next, say, 6 months or something, short-term outlook. This is something which industry reports do, right? For example, CRISIL Research releases these reports, every month, giving the performance. So these are things that you need to keep track of as a credit analyst. Okay, right. Similarly, not just the sales but also the profit margin. Whether profit is increasing or decreasing in absolute terms, right? Then what is the profit margin comparing to the industry average as a whole? How is this company comparing with? So preliminary, these are the 5 things that you need to look into. In case you do not have access to the industry data, the next best thing at least you have to do is to get the compare this company's performance for the current year, the past 2 to 3 years. Okay, so the minimum you need to do is at least the minimum. If you don't have access to the industry data, at least you have to first of all see what is the trend of the sales, whether the sales over the past couple of years are increasing or decreasing, what is the growth rate at which the sales is increasing, and what is the trend in profit margin, profitability, that is PAT by sales, right? What is the overall profit margin? Again, we discussed that there are a number of ways in which you can look at the profit. That is what we are going to do in this example as well. But to get a general feel of the overall profitability, you can look at the PAT as a starting point and see whether the profit after tax is increasing or decreasing, right? So let us start with this company. Okay, so this is the turnover figures of the company. Okay, so net sales, this is what we are seeing, right? There are various items. We have the breakup between domestic and export income. So this is the total operating income, and then we have less excise duty. Finally, we have the net sales. Okay, so just try to get an idea of this company, right? So this company is a huge company. If you look at the turnover, you can see that the turnover is increasing in absolute terms. No doubt the turnover is increasing, right? Absolute terms can be misleading. We discussed this earlier. So as a starting point, let us convert them into percentage, right? Sales are increasing, okay, but what is the percentage growth, right? In absolute terms it is increasing. Let's calculate the percentage growth rate. So how do you calculate the percentage growth rate? So 2009 the growth rate will be sales 15940 minus last year sales, right? 11391 by last year sales. So this will give you the percentage growth in sales compared to the last year, and you do that for every year. This is what we'll end up with. So this is the growth rate in sales of this company for the last 5 years. For this year we do not have the previous year's data, 2007 data, right? So maybe cannot calculate the growth rate, but for the remaining 4 years you can calculate the growth rate. And if you look at it, it's a very healthy growth rate. It's a sort of a haphazard growth rate, a high of around 40% 3 years back. Then it's come down to around, say, 20%, 23%, around that range. Okay, and then last year is the current year, you have again close to 40%. So if you look at it, for the last 3 years, if you look at the last 3 years from 2010, this is what most banks look at. Okay, this company seems to be doing okay in terms of turnover. In fact, I would go to the extent of saying this company is doing extremely well in the past year, because 40% is a huge growth rate. I mean, thinking about your salary, I mean, if you get a 40% increase in salary compared to last year, it's a huge increase, right? It's not a nominal increase. Okay, similarly for the company turnover, it's like salary. Okay, 40% growth rate is a rate which will take it on any day. On any day you will take it. Okay, so this is a huge growth rate, and the last 2-3 years the company is achieving 20 to 23, which itself is a good rate. I mean, you normally look at 10 to 15% sort of a normal growth rate. Okay, so 20, 23, 40 is a good growth rate. So from a turnover point of view, the company is doing well. Again, we have to match it with the industry data, but even then I think you will be finding that this company in the last 3 years especially has been doing well, right? So that in terms of both absolute terms and the growth and the percentage terms, the company is doing well on the turnover front. Okay, so let us look at the profitability. So this is the profit figure for the last 5 years. Okay, so immediately you can see that something is not right. There's a problem in the profitability. It's swinging widely. Look at this profit, 275 compared to last year 1728, right? And then sort of increasing, right? It has decreased here, then it has increased, and again last year, latest year, it has decreased. So 16,025 crores. This is something which as a banker you will not feel really comfortable with. Turnover, yes, for last year's turnover is increasing, but if you look at the profitability, you normally expect profit to increase when sales are increasing, right? There will be cases where profit will decrease when sales are increasing. This is a example of such a company, but normally increasing sales you will associate with increasing profit, right? You will see that sort of a relation, because why would a company really incur losses? I mean, if it's doing well on the turnover front, because no company will sell any product at a loss, right? If a company if a product has cost 10 rupees to manufacture, it will obviously sell at a rate of greater than 10 rupees, right? So obviously 15 or something. So definitely there will be a profit on every product that is sold. So if the sales are increasing, you normally expect the profit also to increase in absolute terms, okay? But here we're looking at a very wildly fluctuating sort of scenario. The sales, if you see, in absolute terms have been increasing for the last 5 years. Growth rate was sort of different, okay? But leave it aside, in the absolute terms the sales was increasing, but you're seeing the profit is swinging wildly, right? It is sort of decreased and increased, then decreased. In the latest year, which we are more concerned with, the profit has actually come down, okay? Whereas the profit, if you remember the turnover in this last 1 year, the turnover, if you remember, has increased by 40%. You recall that? Turnover was around 20%, then 23%, and then 40% in the last 3 years turnover. But look at the profit, it's sort of decreasing. In spite of 40% increase in turnover, profit has decreased. So now I'm not saying that's wrong. There will be cases where this is acceptable. Companies sometimes play what is known as a volumes game, okay? What is a volumes game? If you're a huge company with a lot of clout, you have a sort of a monopoly on the distribution, sort of, you sometimes play a volume game in the sense that you take a hit on your margin, right? You take a hit on your margin and you increase sales. For example, in the market, everybody is offering a product as 20 rupees. Then what do you do to grab the market share? You cut down on your profit. Say the industry is operating at a profit of 5 rupees on every product sold, right? The selling price is 20 rupees, and on every product sold, the average profit for the company in this industry is 5 rupees. Now, what this company will do to grab the more market share, it will start selling at a lower price, say 17. Thereby, it will take a hit on the profit of 2 rupees. Now, the profit will come down from 5 to 2. But in the process, what will happen is this turnover will increase tremendously, because now people will be coming to buy this product because the selling price is low compared to the competitors. Now, this is something what not every company can do. Right? Every company cannot take a hit in profit and survive in the long run. These only companies with deep financial pockets can do. So sometimes big companies play the volumes game. The profit never come down. No, you cannot say that. Okay. Sometimes companies do that. But then again, you have to ascertain at what layer this reduction is happening. So we know that the profit has come down. So where is it happening? Due to what item in the P&L account is the profit coming down? What is the major impact? So now we have to break down that P&L. So remember, we have discussed number of profits, right? PAT is the final profit, but before that we have PBT, the profit before tax, profit before interest tax. You can talk about operating profit, right? We can talk of EBITDA, that is your gross profit, right? There's so many profits, no? So the PAT has come down, okay, but if we find out the EBITDA is increasing, suppose we find out that the EBITDA for the last 5 years is actually increasing, just like turnover for the past 5 years is increasing. Suppose we find out that the EBITDA is also increasing for the past 5 years, and now we know that the profit after tax is actually sort of haphazardly increasing and decreasing. Last year it's decreased. Then you will come to know that this is because this decline in profit is because of items that have come after EBITDA. What the point? Say for example, we have a sales, and then we have a lot of expenses, okay? So let us take all the direct expenses, say raw material, power and all, which will be calculating EBITDA. Till the point of EBITDA, what are the expenses we need to deduct? Let us deduct, okay? So what is EBITDA? Profit before interest, depreciation, tax and amortization. So these are the amortization is for a large company, so let us leave it. Interest, depreciation and tax. So these are the only 3 items, expenses that I have not deducted. Had I deducted, you will get PAT, right? But because I have not deducted, we call it EBITDA. So once we start deducting interest, depreciation, tax also, right, and amortization, okay, then we'll end up with, right? So profit before these 4 items is nothing but EBITDA. So what are the expenses? The remaining expenses will deduct here. All the direct expenses, your raw material, power, labor, repairs and maintenance, depreciation, other direct expenses, right? General expenses, selling and general expenses, all such expenses will direct here, and then we arrive at the EBITDA. So what I am saying is, say for example, there is a scenario where, say, let us take 2 years figures, okay, 2011-12. Say for example, I would say EBITDA has actually increased from 100 to 120, but you found out that PAT has sort of decreased from 70 to 60, right? When is this possible? This is possible only if the sum of these expenses, right, here, right, say for example this is 30 and then you'll get 70, right? This must have been 60 and then 60, right? Got it? 100 minus 30 is 70, 120 minus 60 60. So if we have a scenario where EBITDA is increasing but the final profit has decreased, then you can be assured that somewhere here in between these expenses, interest, depreciation, tax, for this year it is more than this year, and that's why you are finding a decrease in profit, because otherwise EBITDA would also have been decreased. Had PAT decreased and EBITDA also decreased, then there is nothing more to investigate, right? Because then you need to look at why EBITDA has decreased, whether raw material price has gone up or labor charges have gone up. That is a different sort of investigation. But here we are seeing the operational wise the company is doing well, EBITDA, the company is doing well, but some, because of items after EBITDA, PAT has come down. So definitely in between somewhere these items, interest, depreciation, tax, because of these items, this year the expense is more. Now you need to investigate for these items, right? If EBITDA comes down, your investigation will be on a totally different angle, on operational issues, the direct costs, right, like raw material, labor and all, right? If that is not the case, then you have to look into separate set of expenses, interest, depreciation, tax. Okay, got this point? So now let us look at this company. Here we have a company where PAT has come down in the last year, and also in the last 5 years, a couple of instances the PAT has come down, right? Let us now see what is the EBITDA looking like. Okay, so for a moment, let's once again look at the profit. So for this company, the profit is like this. Okay, so it is decrease here. Increased and again decrease. So we also calculate the profit margin. The company has actually a very healthy margin of 15% 5 years back. Okay, then it's come down drastically to 1.72, very low, right? This is very low. Then increased to 8.44, 8.63. These are okay. Profit percentage wise, these are sort of okay, right? Even though the profitability has come down, but this is especially low. So you need to investigate. 2008-9 in particular what has happened here, right? Anyway, in the last 3 years, the profitability and also the profitability for the last 3 years actually less compared to what it was 5 years back. Okay, so let us see. So this can be because of two reasons. Okay, 2008-9 again however we have to focus exclusively. Something horribly has gone wrong, and that's why the profit is so low, right? 275 crores compared to other years. If you look at it, is above 1500, 2000 crores. Okay, for this year it is very low. That is one thing we need to investigate. The second thing is for the last 3 years the profitability is around 8%, 5%, okay, compared to 15% last in 2008. Okay, so why this reduction? Has something increased? Have expenses increased here, or was 2007-8 special, right? In the sense that maybe the raw material price was low, exceptionally low that year. We don't know, right? So these are the two things we need to investigate primarily. So this is the net profit, okay, final profit. If you go one step backward, right, that is before deducting tax, right? From PBT, if you deduct tax, you will get PAT. Okay, so let us go to this step, PBT, that is before deducting tax. You will find this is the scenario. Even here you are finding that it has decreased. So let us go one step backward. Okay, operating profit after interest and before interest. Okay, so operating profit is something which operating profit is where we don't take into account the non-operating income and non-operating expenses. Right, non-operating income. What is operating income? Operating income is the core income from the direct operations of the company. There is something called non-operating income, which we discussed. These are one-time income, which a company should not rely on. We always want a company that is posting operating profit. Okay, a company posting operating loss but posting net profit is not a good sign, because this company is boosting this profit by some one-time revenue, which is not sustainable. Okay, so let us focus on the operating profit for this company. If you look at the operating profit before interest, you can look at the 2008-9 in particular. It's around 1900 crores. And it is at a comparable level compared to the other 2 years. It's still less, but if you look at it, it's a very healthy figure. In fact, if you look at the percentage, you will get a better idea. Look at the net profit for this year. It's nowhere comparable. It's around 1.72 compared to any other year. Okay, 5%, 8% is compared. But look at his operating profit before interest. It's around 12%, and this is comparable with 14%, 14%, 12%. Something happened after this, right? Operating profit before interest. So what are the items that come after this operating profit before interest, right? So one is interest, obviously, because this is before interest. Okay, so then non-operating income expense. So these are the two things you need to investigate thoroughly for this year 2008-9. Something happened between these two items, right? Either the interest was exceptionally large for that year, in which case we need to know why, or the non-operating expense was huge. What is that one-time expense which the company has incurred so much so as to bring down this profit after tax? So let us dig a bit deeper. So if you look at the P&L data which was furnished at the beginning of the chapter, you'll find that the interest for 2008 is very high, right? It's compared to other years. In fact, if you calculate interest as a percentage of sales, right? Interest by sales, you will get a real idea. This year 2008-9, the interest was very high, exceptionally high, and because of that, the final profit has sort of come down. Okay, so that is the reason. There's also a non-operating income. There's also a exceptional loss. This is a non-operating income for that year 2008-9. Okay, already the interest is high for that year. That has brought down the PAT. Then there is added to that there is a exceptional loss. This is a non-operating expense. This is due to exchange loss. Okay, for this company, right? So this is the company has taken a huge hit. So now if you were the CEO of this company, if you want to find out the performance of this manager, of the CEO, okay, of this of the production department of 2008-9, you'll find that the person has not done badly, right? Because you already seen that in terms of EBITDA, in terms of operating profit before interest, really in that year is not that bad. It's around 12%, and it is comparable with other years. Okay, the latest year in fact is also 12%. So it is comparable, right? So you cannot penalize the production manager by saying the profit was lower this year and that's why you're responsible. He is not responsible. The reason why the profit after tax was lower was because of interest and non-operating expenses, both of which are not in the domain of the in the control of the production in charge. Okay, so this is what you need to do. Okay, so whenever you look at profit, you have to be very careful. Your eyes should never jump straight away to PAT and conclude that it is good, profit is increasing, or company is making loss. No, that's not what you need to do. You need to drill deeper, at least at two levels. At least operating profit, and then EBITDA. This is the gross profit, right? You need to, whenever you look at profit, besides looking at the bottom line, right? PAT, you also need to look at these two aspects, because operating profit is going to tell you whether the company is really making profit at the operation level. You need to be, as a banker, you need to be really worried if a company is making operating loss but still reporting positive profit. That is only possible if the company is reporting a very high non-operating income, which is a one-time income, and that is not sustainable. You don't want to be financing that sort of a company. A company which is incurring operating loss for the past 5 years, say for example, for the past 5 years this company is having operating loss, but somehow it is posting a positive profit. That can only happen if the company is having some non-operating income. Say for example, rental income. Every year that rental income is somehow somehow converting the operating loss into net profit. You don't want to be financed that sort of company, right? You want the company to be profitable because of its own operations, because of its core operations, right? So please be careful. Don't rely too much on PAT. Look at PAT, get an idea of the trend of profit, and then drill 2 steps further. One, at the operation level, calculate the operating profit. Operating profit doesn't take into account non-operating income and non-operating expense, right? So that you have to adjust from PAT, so you'll get the operating profit. You want a company that is making a operating profit, not just PAT. You want a company that is making operating profit. Okay. The second thing you need to calculate is EBITDA, right? If you find that EBITDA is well, this is one thing you need to remember. If you find at a first level, if the EBITDA is well, the trend is increasing, right? Operational wise, the company is doing well. Okay, that is a good positive, right? And then you find out the PAT is sort of not as per the industry norm, it is low. Okay, right? Operationally, the company is doing well. Now the company's interest is higher. Maybe the company the credit rating is sort of low. Maybe the bank is charging a higher rate of interest. We don't know. There are various aspects, but those are not at the operational level, right? As far as things are not at the operational level, as far as the problems are not at the operational level, you can be fine, right? Because the other things can be fixed. If things are really bad at the operational level, there is very little you can do. Right? Maybe the company's bargaining power with the raw material suppliers is low. Maybe the company's bargaining power with the suppliers, raw material suppliers is low. In which case, it's not getting a good price discount. No, there's nothing that you can do. That is at the operational level. But if the company is doing well at the EBITDA level, I think as a banker you'll be more happy, right? In spite of PAT not being up to the mark. So whenever you look at profit, please make it a point to remember that take a look at all three profits. Okay, profit after tax, operating profit, and EBITDA. These three will give you a comprehensive outlook on the comprehensive view on the profitability of the company. Okay. Now some banks like SBI also calculate one more ratio called operating cost by net sales. Okay, this is a very good measure. I think you should be employing it if you're not doing it. Even if your bank doesn't have it in their guidelines, you can calculate it and keep aside. On your own you can calculate to get a good idea of this company, right? Operating cost by net sales is nothing but 1 minus, right? It's subtracting 1 by 1 minus operating profit by net sales. Operating profit by net sales. Okay, we know how to calculate operating profit. Okay, so operating profit means then you add the non-operating income less non-operating expense, right? Then you'll get PBT, then tax, and get PAT. Okay, so this is operating profit, right? So if operating profit is 5% and the operating cost will be 95%, and again this will be, you need to compare it with the industry scenario, right? So as discussed earlier, always use EBITDA. Okay, focus on EBITDA a lot. So for this company, if you calculate EBITDA means you have to add back to the profit after tax what all you had, interest, depreciation, and tax. Amortization for this company, there is no amortization. So add back IDT. A is not there. Okay, so you add back, you'll get EBITDA. Then you calculate percentage of EBITDA by net sales, and now you see this ratio. Okay, so this company is actually, if you look at the EBITDA, this company EBITDA has come down in the latest year compared to last 2 years. Okay, so it's around 24, 21, and then it's sort of decreasing. Okay, so now you need to be worried. Now you need to be it's not too low, but still EBITDA is coming down in the last 3 years, so you need to investigate, right? You need to, of all the profit measures, EBITDA is most important, no doubt about it. But then the individual breakup, why it has come down, is something you need to investigate. So if EBITDA is coming down, how do you find out why EBITDA is coming down, right? I told you the most important profit of all profits, profit after tax, operating profit, right? EBITDA is most important. This is the gross profit. Okay, even though your bank doesn't have the name called EBITDA, you please calculate EBITDA, find out what it is, and calculate the margin. So if you find that EBITDA is decreasing, as in this case, the first step you need to do is to find out why. Because EBITDA relates to direct costs, and if a company's direct costs are increasing, the profit is never sustainable. Right? It will always come down. Maybe in the next year it will come even further. It will come down even further. So you need to investigate. First of all, you need to fix it at the operational level. Why the costs are increasing? Because the costs are increasing at the operational level, only then your EBITDA is coming down. Because EBITDA is all about operational costs, right? If your operational wise your costs are efficient, EBITDA will keep on increasing. But if you see that EBITDA is coming down, something is happening here. The operational costs, whether it is raw material or power, something at the direct cost level, something is increasing. So how do you find out what is that, right? To do that, what you need to do is you to calculate a percentage of each and every direct cost as percentage of sales. Okay, this is one thing that many of the good analysts do. Okay, what they do is they calculate all expenses in the P&L account, as percentage of net sales. Say for example, they take raw material, right? Raw material will have some figures. Okay, 10 crores, 12 crores, 13 crores, like that. They have sales, say 100 crores, 110 crores, 115 crores. What they do, they calculate raw material as a percentage of sales. For this year it is 10%, 10 by 100, then 12 by 1.1, 13 by 1.15, some percentage. And then they calculate, then they'll see what is this raw material percentage cost as a percentage of sales, whether it's increasing or decreasing. Okay, whether it's increasing or decreasing. This is greater than 10% here, both in cases. So then they find out that the raw material cost is increasing. So raw material as a percentage of cost is increasing, is on an increasing trend for the past 3 years, and then they will take corrective actions. Maybe they will bargain with their raw material suppliers for discount, or maybe they cut down on the credit period, whatever they can do. Okay, so you need to find out what is the reason. So to do that, you have to calculate each and every expense as a percentage of net sales. Let us do that. This is what, in order to investigate EBITDA further, this is what you have to do. If EBITDA comes down, this is the first thing you have to do. You have to calculate major expenses, raw material, stores, power, labor. These are the major expenses. Okay, and then you calculate as a percentage of sales. Okay, for 2 years, let us see. almost by 5% raw material as a percentage of sales is increased. This is a huge jump, okay? Because the rest of all are around same percentage, 4.98, 4.54, 554. Power has actually come down. That's a good sign. Direct labor 253, 229, 166. So by and large, you can see there's a correlation. By and large, they are same, okay? Except for interest and raw material. Interest is not a direct expense, but look at raw material. I mean, this is a huge. I mean, last year in 2010, raw material was around 60% of sales, but now it's 65% of sales, right? This has led to decrease in EBITDA during that year, okay, right? So what you need to do is calculate the major expenses as a percentage of sales and see where the percentages increase, right? So it is because of that reason that EBITDA has come down, right? Why we are doing this? Why we are calculating all expenses as a percentage of net sales? Because if net sales increase, you don't find expenses being increased, okay? Take for example your bank, okay? Say this is the telephone expenses for a bank as a whole, 3 crores, 10 crores and 40 crores, okay? And this is your business for a bank as a whole, for 500 crores, 13,000 crores, 30,000 crores and 25,000 crores. If you calculate telephone expenses as a percentage of business, this is a percentage you're getting, right? So now if your CMD in your review, in a bank overall review, he finds that telephone expenses is between these 2 years, okay? If he finds that the telephone expenses increase from 3 crores to 10 crores, 300% times it has increased, and then it's increased by 3 times, and he shouts at all of you, all of you are using all of you are using telephones for personal calls. See, the telephone expenses increased 3 times. It doesn't make sense, because even though telephone expenses increased 3 times, but to justify that, the business is also increased by 3 times. If you look at it, 4,500 into 3, it's around 13,500. So the business has also increased. So it's not just expenses have just increased without increase in business, right? So now you can say that yes, the telephone expenses have increased, but it is because of getting more business. We are talking more to customers. Yes, there is a justification, right? So CMD will be wrong in this case, right? If he says telephone expenses are increasing by 3 crores to 10 crores, in absolute terms they have increased, but as a percentage of business is around the same level. However, in the next year, if you look at it, it has increased by 4 times the telephone expenses, but whereas the business, if you see, it has just increased 2 times. Okay, so as a percentage of business, this has most. So now the percentage is increased from 0.08 to 0.16. Okay, then the CMD might have a point. Okay, so telephone expenses is something which nobody will be tracking of, but this is an example. The point is, the moment you calculate all expenses as a percentage of net sales, then you will be in a position to comment why the profit of the company has come down. So say for example, your power bill has increased from 1 crore to 3 crores. It might look like a huge jump, but really if you calculate as a percentage of sales, if the turnover has increased from say 100 crores to 300 crores, okay, you need not be worried at all, because how you are going to generate more sales? By having more production, and to have more production you need more power. So when the business has increased 3 times from 100 crores to 300 crores, so obviously your power expense will also go up, because you're producing more goods. So this is nothing to be worried about. So if you look at absolute figures, you'll be getting a bit intolerant. Okay, this is so much jump. But the moment you convert it into percentage of business, percentage of net sales, everything sort of evens out. Okay, so that is why you have to do this. The reason why we did this was exactly that. Convert every major expense as a percentage of net sales and compare it with the previous year. Say the latest audited balance sheet available to you is 2013. Then you compare the major expenses as a percentage of sales for this year, 2013 sales, and then you also do the previous year, and then you will come to know under which head the expense is starting to increase, and then you can take the required corrective action, right? So for this company, for the example which you are considering, let us do the what we have suggested, right? The percentage in terms of net sales, right? So if you look at it, raw materials, you can see something happening here. 5 years back, the raw material cost as a percentage of sales was very low, around 50%, 52%. And then it sort of shot up to 65, it was 64, 62, 60, around 60. So something drastically happened. It has jumped by 10%, right, in 2008-9, and then it's maintained around the 60-65 level. So if you had a high profit in 2007-8, yes, you had a very high profit. If you remember, the profit for this year was exceptionally high, 15%, whereas other years it is around 8%, 5%. Okay, 8-9 anyway, it is low. That we found out why, because of high interest and exceptional loss due to foreign fluctuations, right? Leave that year, but compared to other years, the percentage profit figure was high this year only because the raw material cost that year was low. Since then the raw material prices increased by more than 10% as a percentage of sales, and that's why you're seeing a profit around this level. So now in the CMA data for the coming, say this company has now come for enhancement of working capital limit and submitting CMA data for 13 and 14 next 2 years. Now you have to see what is the percentage of raw material cost the company is projecting as a percentage of sales. It should be around the 65%. Because last 2 years it is around 65%. But if it projects something like 52%, then definitely it is because of with an intention to reduce the raw material expenses and show a higher profit. That is what you have to question, and this is why this percentage becomes so important. The moment you have last 2 to 3 years data, the percentage of major expenses, percentage of sales, you can compare how the company is projecting in the same data, and if there is a wide mismatch, then you can definitely point it out and saying because of this you are getting a higher profit. Had you taken it at these levels, your profit would be lower. Maybe you will run into loss. We don't know, right? So that is one thing you need to do, and you need to do it for all expenses, right? Let us see the other expenses. Stores and space, by and large, if you see 4 to 5%, right? So that is there. Power and fuel, I think is around 5.5. Not a major variation, right? Again, labor 2, 3, 2, 2. Last year it has actually come down. We've seen that. That's all right. Repairs and maintenance around that 2% mark, right? So you're seeing that there is no major variation in other items. General expenses, selling 2.5 to 1.5 is coming down actually, right? For the last 3 years, 1.8 is 4.3. This is okay. Interest anyway, that's different. But even in the last 2 years, it's around 3%. So basically, from this table, you need to be worried about the raw material. Okay. So what happened was 5 years back, the raw material cost as a percentage. Maybe this is an industry-wide scenario. This is not for this particular company. Maybe this. By the way, this is JSW Steel. Okay. The balance sheet which we are analyzing is JSW Steel. And if you remember, in 2008, the steel industry had a fundamental shift. The raw material price completely changed from 2009 onwards, completely changed. So there's a background to it. It's not a company specific development. It affected the industry as a whole because steel industry is cyclical in nature. Okay, so it sort of increases then decreases the performance. So that's important. That's the reason why you have to always see the company's performance in the context of the industry scenario. Okay. So in the previous chapter on ratio analysis, we have calculated a number of ratios. So let us calculate for this company. Okay. So let us start with the return on capital investment. If you remember, this is how we calculated return on capital investment. So this is what, if you remember, this is the formula which we used. Okay. So what we did, to the profit after tax, what we did, we added the interest into 1 minus tax. Okay. Why we did that, we had a discussion, right? And then we divided by what is known as the invested capital. Invested capital is nothing but net worth plus all your debt, both your long-term debt and short-term debt. This we discussed in the previous chapter. Please refer back if you want more clarity. We have calculated accordingly, and you can see that the return on investment capital, let us focus on the last 3 years, right? It's sort of okay, right? 6%, 5%. Say this is around 5%, so 5 to 6%. Is it good? Is it bad? You have to compare it with the cost of capital of this company. That is something called as the weighted average cost of capital. Might be an advanced topic, but still, for this company, 5 to 6% is a good return on investment capital. Right, we can say that. Okay, it's also a good practice to calculate ROTA. This is known as ROTA, return on total assets. This is a ratio which we didn't discuss in depth in the previous chapter, but we had a mention of this. So return on total assets is basically profit after tax by your total assets. Right, this is nothing but in the balance sheet whatever you get the total assets. Okay, so again you have to compare it with the other companies in the industry with similar size. ROTA is actually tracked a lot by the analysts in the equity market, okay, for the share market. But doesn't harm if you calculate ROTA also. At least see the trend whether it's increasing or decreasing. And here you find that in the last year it's sort of decreasing. So let us look at the next ratio, current ratio. If you calculate current ratio, you know how to calculate current ratio. This current assets by current liabilities. Please refer back to the chapter on working capital assessment, where we had an in-depth discussion on NWC and current ratio. For this company, you'll find that the current ratio has been less than 1 for the last 5 years. Now, as a banker, you are really worried about it, but let me point out a couple of points. For calculation of current ratio, classification matters a lot. What are the items you are taking as current assets and current liabilities? So this is JSW is a big company, right? So there's something called investments in group companies. Okay. So now investment in group companies have taken entirely as non-current assets, but actually the balance sheet of JSW has given the breakup between how much of this investment is current and how much of this is long term. So if you take that into account, the current ratio will definitely improve. And second, the term loan installment due in 1 year are taken as current liability, whereas some banks actually treat it as term liability. So there are a couple of treatment differences. Okay, so for our analysis, let us stick with whatever I've done and we'll calculate the ratios like this, right? So based on your bank or policy guidelines, you can revise the ratio. But the low current ratio doesn't necessarily mean the company is doing badly. Okay. I told you earlier that there is a minimum norm of current ratio for banks, say 1.33 or 1.15. And because for this company it's always less than 1, because less than 1 basically means the NW is negative, isn't it? NW is negative. So NW is negative is not a good position, because what it means, the current assets are not being financed by long-term sources. So entire current assets are being financed by short-term sources, and moreover this excess of the short-term sources are being diverted into long-term uses. So that is diversion of funds. So current ratio less than 1 is definitely not acceptable, but this is where a different dimension of current ratio emerges, which I didn't discuss earlier. For large companies, I'm speaking of very reputed companies, current ratio needs to be looked at in a different aspect. Okay, let us assume you're a very reputed company, a highly reputed company, so reputed, like Reliance or somebody, huge company. Everybody wants to do business with you. Okay, let us assume you're that sort of company. Okay, so current assets is 100 lakhs, right? Current liability is 90 lakhs. A bank borrowing of which 50 and 40 bank borrowings and creditors 40. So obviously there's a long-term funds of 10 lakhs is used to finance. Okay, right? So this is the present position. Okay, so 100 lakhs of current assets of this company are being financed by 50 lakhs of bank borrowings. Okay, creditors are giving 40 and NWC is 10. Okay, this is the present scenario now, but this is a very huge company and everybody wants to do business. Okay, so what the suppliers, the raw material suppliers of this company are telling is, presently creditors is 40, right? So what they're saying is, you don't pay us after 1 month. No, say the normal credit period is 1 month, but say you pay after 2 months, 3 months, 6 months. You take whatever time, because these companies want to do business with this company, because this is a very reputed company. Let's take the example of Reliance. So the suppliers, if you're a supplier, if you're a small time supplier, it's a huge prestige to get the order for Reliance. If you are supplying to Reliance, the benefits will be more, even though you might take a short-term hit on your liquidity position by giving more credit to Reliance. But the long-term business you're going to get is huge. So you're willing to take that hit on your short-term liquidity, right? So for this company, what will happen is, if you have a very reputed company, you'll be having a lot of creditors, not just 40. Say for example, it will shoot up to say to 60. Now it's not 50, it's 60. Now what will happen? OCC is 50, but now it's able to get creditors 60 lakhs. Right? So what will happen? NWC doesn't come into picture. It doesn't require NWC. Already it is 110, whereas current assets is only 100. So this will be financed entirely by 100, and moreover there will be a surplus of 10 from the short-term sources. This will be going into long-term uses. This is what is appearing as diversion of funds. But this is technically not diversion of funds. Now, if you think about it, a company which is not in a great financial position willingly diverting short-term funds to long-term sources is okay, that is not acceptable. But for these sort of reputed companies, what do you do when you have a lot of credit? Your reputation is so high that your creditors, your raw material suppliers are giving you so much credit. Now what do? That is a sign. That's a good sign. Now people are giving so much credit, right? It is so high that I don't need to put in my NWC. There is no need to. The NWC doesn't come into picture. These two are alone sufficient to finance the current assets, and moreover I'm still left with excess funds, and that's why I'm putting them into long-term uses. Now as a banker, what you should do in these sort of situations is, you should never allow this sort of situation to arise. I mean, if it really is this sort of situation, your CC should be restricted to 30, not 50. Right? And then the borrower margin should come into play. Then it should be 30 plus 60 plus 90, 30 plus 60 plus 10. Together make that 100. Right? Your bank borrowing should always be in tune with the other funds the company is obtaining from the market. Say creditors is very high, then your bank borrowing should come down. As a banker, you have to reduce your CC, so that overall the company is not getting in a position where it's having surplus funds and those funds are being diverted into long-term uses. Right? So the company cannot say, I have a lot of funds, I don't need to put in NWC, that's why my current ratio is low. No, you can't do that, because as a banker then you need to withdraw from this company, because this company doesn't need your short-term sources from the bank borrowings. It's enjoying so much reputation that the creditors are alone able to finance the current assets. Maybe some NWC, but then it doesn't require as a banker. So you should not get in a situation where the company is not putting NWC when the NWC is negative, because that means the borrower's margin is not there. The long term, because the current assets are being entirely financed by outside borrowing, creditors and bank finance, and those funds, what is happening? Those funds are being put into long term uses. Part of those funds. Okay, so this is not an ideal situation. you need to be aware of, you need to be careful in those situations. Okay, let us calculate quick ratio. We've seen how to calculate quick ratio. So quick ratio is just like current ratio, current assets by current liabilities, but we will not take entire current assets, we will reduce inventory, right? So let us reduce inventory, let us calculate current quick ratio. Since current ratio anyway is less than 1, you also have, obviously quick ratio will be less than 1. So nothing more to look at it here, because we discussed on current ratio, right? Right, the point that you need to remember is, for large companies, low current ratio and low quick ratio is not really a big concern, right? So you should also always remember, does the company has the credibility to raise funds at a short notice? If you're a really huge company like Reliance, say for example, today you urgently want some, say 10 crores. Just by picking a phone, just picking a phone to the banker, this company can, Reliance, a company of the stature of Reliance can arrange 10 crores within no time, if it really wants that. Now that is liquidity. See, liquidity is not really about your financial position. Now, in the long term, yes. In the long term, yes. But if you're speaking of today, tomorrow, liquidity needn't be reflected in the financial position. It's your ability to raise the short-term funds at a short notice. So if a company is so reputed that it can raise the short-term funds as and when needed, your current ratio, a low current ratio will not be a problem. And that's why you'll find that if you actually analyze the financial position of the really top companies, very big companies, the current ratio will be less than 1. You'll be surprised to know that current ratio will be less than 1 for those companies, because those companies are enjoying so high reputation in the market. They're getting a lot of creditors, right? And they can, and in spite of having a low current ratio, it's not a worrying aspect to the banker, because this company can always arrange funds at a short notice. Okay, what is the problem if you have current ratio less than 1? Really, what is the problem? What we are saying is, your current assets, say for example, let us take inventory plus debtors, okay, and you have the creditors. Let us assume these are the only aspects. These are the only items. Inventory and debtors are the current assets, and creditors are your current liabilities. Let us assume you have inventory, say 30 lakhs. Debtors we have, say 20 lakhs. Whereas your creditors is 70 lakhs. Only then you'll have a current ratio less than 1, isn't it? Only when the denominator is more than the numerator. So this put together is 50, and now it's 70. The problem is, what is the problem here? Say you're going to get this 50 lakhs in the next 2 months. Okay. So this inventory is going to convert into finished goods being sold, and convert into data is going to come back as cash in the next 2 months. Data is also, right. So let us say 2 months. Let us assume also your raw material creditors are going to ask you for the 70 lakhs in the next 2 months. So in the next 2 months, you're going to get only 50 lakhs cash, whereas your payments to be made is 70 lakhs, and you have a liquidity problem. Right? That is the problem. That is the problem with the current ratio less than 1. You cannot meet your immediate short-term payments, short-term obligations. That is the problem with, that is what a liquidity problem, okay? But if you are a reputed company, this will not hamper you, this will not worry you, because 1, your creditors will wait if you want them to wait. 2, if it really comes to a situation where you need to arrange, if it really comes to such a situation where you need that 20 lakhs additional to pay the 70, you can immediately arrange it, because you're so highly reputed in the market, you can immediately arrange 20 lakhs somehow. Right? So low current ratio for big companies, very big companies, is not a concern. So whenever you're dealing with a very large company, you please keep this point in mind. But otherwise, for a normal company, day-to-day companies which we encounter in the banking industry, definitely current ratio less than 1, like this in this example, is something which you need to be worried about, right? Then we can calculate one more ratio, interval measure. If you remember, this is how we calculate it. It's basically for how many days, right? For how many days the liquid assets of this company can finance the daily operations. Okay, so you're getting this for the last 2 years, you can say around 80-90 days. So it's actually increasing, right? So 50, 60, 80, 90. So this is a healthy sign. So this company has got enough liquid assets which can finance the operating cost for another 3 months. So this is a good situation. Okay. Let us look at the debt equity ratio. You can calculate debt equity ratio. Debt equity ratio, debt here means long term debt. Okay. Had it been both long term and short term debt, you'll have a ratio called TOL by TNW, because TOL is total outside liabilities, both short term and long term. Debt equity ratio means only long term. Okay, so calculate the long term debt by net worth, you'll get this ratio, and less than 1 is actually, this company is a loaded company. Okay, so I mean usually 2:1, 3:1 also is acceptable. So this company seems to be having a lower debt than most of the companies. So that's not so why is this important? Because this is important because in case if this company wants to raise finance, a low current ratio will be, a low debt equity ratio will be a positive point for the banker, right? Because this company because a low debt equity ratio will be will be providing flexibility for future borrowings, right? But if already the company has got a very high debt equity ratio, say 3:1 or 4:1, already it is high. Now it wants additional funds from the banks, and banks will be reluctant to finance additionally, because debt equity is already high. Okay, so a low debt equity ratio is always a positive for the bank, from the bank's point of view. So this company less than 1 debt equity ratio is a positive sign. Let us calculate TOL by TNW. So TOL means total outside liabilities, both current and term liabilities. So add term liabilities, current liabilities, you'll get this ratio. Normally bank norms, it varies. Sometimes they'll say it should be less than 6, less than 5, less than 4. Okay, this is less than 2, so it's okay. Right? Nothing. So, right. Now, if this company also has non-fund limits, you can calculate what is known as gearing ratio. This we discussed earlier. Gearing ratio is also similar to this formula, TOL by TNW, but you also add the non-fund limits. And from here you deduct the non-current investments. Okay, so if you have information on the non-fund limits, you can calculate the gearing ratio as well. Interest coverage ratio, that is a very simple formula, PBIT by interest. Straightforward, you can calculate. Usually around 3 is advisable. So okay, I mean it's 2.89 it's okay, right? Nothing to be worried at. Okay, it's decreasing, but I think this year it was. But this year the interest the profitability has come down, right? If you recall, the profitability of this year was around 5%. Now compared to last 2 years of it, around 8%. Okay, so this profit was less. Maybe that's why the interest coverage has come down. So nothing to worry. I mean around 3 is okay, right? You can calculate the holding levels for this company. So this company is holding inventory. If you look at the last 3 years, around 1.3. What is 1.3? It means around 40 days. So this company is maintaining raw material stock of around 40 days. So even if the raw material doesn't arrive for the next 40 days, this still the company can continue its production. That is what meant by raw material holding. Okay, so again, whether it is high or low, I mean this is again a requirement of, you need to as a banker, you need to step in and look at the industry. So whether all the companies in this sector are maintaining this sort of holding, is it really required, right? Those sort of things you need to look at. But if you look at the last 3 years, it is around the same level, so this is reasonable. Work in progress is actually a function of the production process, so at the same level by and large. Finished goods holding is around 1 month, 0.75, 0.6 is okay. Not much variation. Okay. Debtors is around 0.4, 0.5, right? So what it means is around 2 weeks, roughly around 2 weeks. So this company is giving a time of two weeks to its customers to pay. Is giving extending credit period of around 2 weeks. So again, for the last years, around the same level. So this seems to be a very strong company. Normally you will see credit period being extended 30 days, 45 days, 60 days even. But a very strong company can dictate terms. A company like JSW Steel can dictate terms. So it's giving a very low credit period, and whereas it's obtaining a very high credit period from the suppliers. You look at this, it's around 4-5, and it's been for the last 5 years. So this is what you want actually. You basically, if you deduct the debtors minus creditors period, the holding levels. So here 0.47 minus 5.28. This is something you want to calculate always. You always want this to be negative. What it tells you, or alternatively, credit period 5.28 minus 0.47, you want to be positive. What it basically tells you is how much is your bargaining power. If this is very high, what it means is you're having a lot of power. You are able to dictate to the debtors. You're also able to dictate to the creditors. You're offering very low credit period to your customers, whereas you're able to obtain very high credit period from your suppliers. That alone will be sufficient to cover your, in many cases, that alone will be sufficient to cover your working capital requirement. If it is very high, with that funds alone, you can manage your working capital without resorting to bank finance. You can do that. I mean, if you're that sort of a company. Now, some analysts also calculate what is known as a cash cycle. Okay, from this data we can calculate cash cycle. Basically, it means number of days for which cash is blocked as inventory, number of days for which cash is blocked as receivables, minus the creditors finance. Right? You can do that calculation. So same figures which we already calculated. You're going to end up with like this for the last, and this is the cash cycle. So basically, what cash cycle means is number of days for which cash is blocked like this. You're getting negative here because creditors is very high for this period. What it actually means, the physical interpretation, what it actually means to be the cash cycle being negative, what it means is, I think we have in the references where I think we have a very good book called Bob Ross, How to Interpret Bob Ross book. Please go through this. I think the relevant section is, I think that's got a very good interpretation. What a negative cash cycle basically means. Say for example, if a negative cash cycle is 10 days, what the interpretation is, a negative cash cycle of 10 days can be interpreted like this. Okay, so company is is availing the OCC limit, it is holding inventory for say 10 days, right? Then it is selling to customers for say credit period of 1 day. So total 11 days, okay? So till that is normal. Normal holding level inventory, credit period, debtors period 11. If you have some creditors say 1 or 2 days, you'll have a positive cash cycle. But here you're getting a very high, say 21. So then you're retaining this cash for another 10 days, right? Before you pay the creditors, you're not immediately paying these creditors, right? Okay, so that is the interpretation. It means that you, because your credit period is so high, you're able to retain that cash in the business, and this you can use for other source, some other things which you want as a company. A big company will be having that option. Okay, normally you want the normally for small companies the cycle will be very fast. You obtain material on credit, raw material on credit. You do the manufacturing, processing, store it in finished goods, immediately dispatch it in say 1 or 2 weeks, sell it, get the sell it on credit to the customers, get back the cash, and with the cash you pay back the raw material supplies. It will be very fast sort of turnover. But for large companies, this is what happens. You'll be having the flexibility to wait for some time, say 10 days, before you make payment to the payment to the creditor. So that is the interpretation of a negative cash cycle. Now, very strong companies do have this situation. Okay. So one more ratio you can calculate is working capital to sales ratio. It's just the ratio of working capital limit to the sales. Okay. So working capital to sales. So what is working capital? It is inventory plus receivables minus creditors. This is a major portion. Okay. You calculate as a percent of sales, you will be getting a one ratio you can calculate. Banks usually do not calculate this in the appraisal, but I think you can calculate it. Okay. It's again for this company it is low because it is negative because creditors are very high. Now maybe this company doesn't require bank finance. So working capital. Okay. So basically what it tells is for increase in turnover of say if this ratio turns out to be 10%, what it means is if the turnover increases by 100 lakhs, the additional working capital required is 10 lakhs. And that's what it says. But here a negative means maybe this company doesn't require any additional working capital because the creditors are financing, and that's why it's negative. Okay. But usually you will get a positive figure. Say for example 5%. What it means is if the turnover of the company today is 100 lakhs, and if the company happens to increase the turnover to 125 lakhs, so for this increase in turnover, it will be requiring an additional, for every 100 lakhs increase in turnover, it will be requiring a 5 lakhs of additional working capital. For 25 lakhs, it will be requiring 1.25. Okay, so 1.25. That is what the interpretation is. Okay. Some banks also calculate the bank finance to sales. We have calculated working capital to sales. Some banks actually calculate bank finance to sales. Many banks use it actually. Usually a benchmark norm usually is around 20 to 25%, right? Again, it comes from the turnover method, which is usually not applied for huge limits. Say for example, above 5 crores, you don't usually use turnover method, but still, bankers have this sort of a thumb rule which says that they will take the turnover and say 20 to 25% around that range. So if you are having a company of turnover of 100 lakhs, banks feel that a working capital limit of around 20 to 25 lakhs is reasonable for this company. Again, this can be high. It can be low. On a company to company basis, this will change. Say for example, this company is operating in an industry where raw material is very scarce, or there's seasonal industry where raw material needs to be piled up. This company doesn't 3 months stock of raw material is not going to be enough. Maybe this company requires 4 months or 5 months. This can happen. In which case, this will be more than 20 to 25%. Now that is a specific case. Now these sort of things do happen, but bankers somehow have a sort of a benchmark, a thumb rule. They just look at the turnover and calculate say around 20 to 25% and say this is a sort of ideal limit, working capital limit to be sanctioned for this company. They will sanction if required at a higher level, but then this is a sort of a norm which many banks follow. Now having analyzed this company JSW Steel, I think we can now move on to what are known as accounting red signals. Now accounting red signals is something which usually happens for the large companies. For small companies, it happens all the time. I mean, if you're a banker, if you had any experience with small time, small time is small SME borrowers, or even in the mid-sized companies, you'll find a lot of manipulation by the auditors. Okay, even you're not even comfortable with the audit balance sheet. You don't know whether these are the true figures or not. These sort of things do happen at the small level, and the checks you need to employ in those sort of situations is totally different. I'm speaking of large companies here, companies which have a professional setup. Their auditors are reputed, and then there will be some accounting red signals which throw up. uh, maybe you will not be encountering that sort of a companies in your career, right? You're following more mid-sized companies, uh, but still this section will be important. This section will be useful in case you encounter those sort of situations. So I'll tell you some 4 to 5 red signals. Now in your accounting, in the balance sheet and P&L account, if you happen to see these sort of if you happen to see this, it should point as a flag to you, okay? A sort of a red signal that something is not right, okay? And probably you might have heard about the term Enron, this is a energy giant, this is a huge company, and then some accounting fraud has happened, and some fraud has happened there. Sales has increased so much time, during this 5 years period, 95 to 2000, sales has increased by more than 1000%, from 189 billion to, whereas profit has increased by only 88%, right? So this is something always need to watch out. If your profit is not increasing as much as your sales, your sales is increasing for the last 2 3 years, whereas the profit is sort of flat or decreasing. You need to be careful. It's not going to happen always, but then this is something you need to be, because it points to some accounting manipulation. Okay, so let us see some accounting red signals which you can look at for large companies. Okay, so one thing you can look at is a free cash flow. So what is free cash flow? Free cash flow is, this is free cash flow. Okay, I'm not going to do the derivation. You can refer to any standard textbook on financial management will provide this in reference. I think we have given the book on I.M. Pandey. Any standard book on financial management will have the derivation. Basically, this is what cash flow, right? Let us calculate using this formula the cash flow for a company. For the example we are considered, this is the cash flow. Okay, see cash flow. Whenever you see cash flow sort of decreasing, here you see cash flow has increased here and has decreased. Whenever cash flow has decreased, you have to be very careful. Okay. Again, for here we have a lot of different classifications. There is an item called change in NWC, and our classification of current assets and current liabilities are different in this company. I already told you there are a couple of differences between what the company has adopted and what we have considered. So for this company maybe it's okay, but generally if you see that cash flow has decreased, you need to be, especially with the sudden decline, such a drastic decline, you need to be very careful, because it points to definite problems. The other thing you need to look at is receivables will be increasing disproportionately compared to sales. Okay. Now, again, this is usually done by very large companies, but the point, what they do is they will start recognizing sales. Revenue recognition is again an accounting terminology, which if you're okay with it, you can follow. Otherwise, it doesn't matter. What it basically tells is, even before the delivery of the good has happened, so when are you going to recognize the sales? Sometimes what happens is in long-term contracts, revenue will flow over a number of years. Say for example, if this is a contract for say 3 years, I will get a turnover from this client. I will get a turnover of 10 crores, 15 crores, and 20 crores for the next 3 years. This is a long-term contract. Now, what I will do in my balance sheet, in my P&L, for this year itself, I will record this entire 45 crores. You can't do that. This is against the accounting guidelines, but sometimes companies do that in order to boost the income, because many companies are listed companies, and performance of listed companies are being tracked by lists. The share price is highly correlated with the performance. If you don't post if you don't meet the market expectations, your share price will come down. So there will be a lot of pressure on the management, and they'll be resorting to all sort of accounting gimmicks to increase the sales or increase the profit. So if you sort of come across this sort of situation where, how do you catch this? So okay, in a P&L you show 45 crores, fine. So last year it was 40 crores, 45 crores, 40 crores. Now it is 45 crores. It is increased. You'll place a tick mark. Okay, this is good. But where you can catch this will be reflected in the receivables. Because you're not going to get the cash in this year, right? This will be staying as receivables. For the next 2 years, it will be staying as receivables. So when you have a situation where receivables are increasing very much compared to sales, it is an accounting red flag. Okay, so watch out for this. Now, one more thing you need to watch out is the buildup of inventory, right? If you see inventory piling up, if you see steep increase in the inventory holding, it might signal to obsolete stock, okay, or slow moving stock. Okay, now you might ask, what's wrong if a company keeps higher stock? I mean, it can have. Okay, there's nothing wrong in keeping higher stock, right? Sometimes companies, sometimes industries are seasonal in nature. Sometimes company will be doing some short-term promotional activity. So short-term build-up of inventory is acceptable, but again you have to look at the reasons for this inventory build-up. Right? Is it because of piling up of obsolete stock, or because of any genuine reason? Okay. The last accounting red flag that I want to point out is net profit and cash flow from operations. Okay, so if you should always compare these two, net profit and cash flow from operations. I know cash flow statement is a sort of a daunting a task for many bankers. Cash flow is an advanced topic, but if you happen to come across a balance sheet which also gives you cash flow statement, okay, I'm not saying you drop the cash flow statement, you cannot do unless you have additional data, but if you sort of come up across a big company which along with its P&L and balance sheet also furnishes the cash flow statement, you compare the cash flow from operations to net profit, okay, because cash flow will be broken down into various categories, okay. There will be cash flow from operations, cash flow from investment activities, and cash flow from financing activities, okay. Now you take this cash flow from operating activities and compare with the net profit, okay. If you have a situation, right, if you have a situation where net profit is increasing but whereas cash flow from operations is decreasing, then definitely you have to seriously doubt the accounting. Now something is basically wrong. There's some, usually it points to a situation of accounting manipulation. Now some accounting manipulation happening, okay. So you need to investigate further. So all these accounting red flags which I'm discussing is applicable for very large companies, because small companies won't be doing. I'm not saying small companies won't be doing that, because small companies will be having a different sort of techniques to deal with it, okay. Because those companies are not really concerned about this cash flow. The auditors, I'm speaking, the auditors who want to manipulate the financials of small companies will not be manipulating these sort of things, okay. Receivables, they won't be manipulating these cash flows and all this sort of stuff. But if you ever happen to be dealing with a portfolio of large advances, very large advances, dealing in above say 50 crores turnover, 100 crores turnover, in those sort of companies, keep a watch on these accounting red signals, okay. They'll be pointing out to, because they might point out to some accounting manipulation which you can then take up with the company, right. So with that we come to the end of this chapter, right, in chapter 10. What we'll do in the next 4 chapters, as I already discussed in the beginning of this chapter, in the next coming 4 chapters we'll be discussing 4 case studies, 2 on term loan, right, and 2 on working capital, right. So that will be a comprehensive take on all sort of processes you might encounter in your a day-to-day career, okay. So from the term loan point of view, we'll be taking 2 proposals. One, a fresh term loan, and second, term loan has been sanctioned say last year, and now the company has come for some other facility, say working capital, and then you need to check how the project has performed, whether the margin was brought in, things like that, okay. Then we'll take 2 proposals related to working capital, a regular working capital enhancement, and then the cash budget, okay. So 4 case studies we'll be doing in the coming 4 chapters, right. See you then.